There's a truckload market flip brewing, but it's currently on the ocean.
Hey guys, welcome to Shifting Gears. My name's Grayson Harris. That's Henry Byers over there. We're right in the middle of the year, right in the middle of summer. It feels like it with how hot it is outside. Speaking of things that are hot right now, what's hot in the truck market, Henry?
Yeah, I think Shifting Gears is an appropriate title for what's going on in the market right now. I have a thesis this building that we're likely to see a truckload market flip here in the second half. And I think the data points we'll talk about today will support that thesis. And the market's been wanting to do this for a while now. Certainly when you look at something like the National Truckload Index, moving 7-day average of spot rates, including fuel, you'll see that in the last couple of years, obviously have been really experiencing a freight recession. And if you look at the way rates are performing this year with the amount of capacity that's still in the market, to me, it really is getting primed for, if anything significant happens as far as a disruption, for those rates to, increase significantly. And what you're going to see is likely a lot of carriers, opting out of contract rates that have been signed really at historic lows, adjusted for inflation, and also looking at, operating cost for a truck.
Yeah, well, what are some of the disruptions that we might need to be on the lookout for that could, lead to that market shift that you're referring to?
For sure. So this next chart's looking at really the comparison between contract rates and spot rates. Contract rates being in white, spot rates being in green. If you look at this most recent period here, and this is including the national diesel average from the EIA, but essentially we're seeing a nice upward trend, and we really have been seeing an upward trend since what we would have considered the bottom of the freight recession, May 2023. And so if you look at this spread between contract rates and spot rates, the more that spread narrows, the more likely there is to be service failures, from these shippers signing these, really low contract rates. I mean, they've been incredibly low. And I think a lot of shippers may be setting themselves up for a pretty risky time period where, again, rates continue to creep up. You're going to see a significant amount of rejections and therefore service failures for these shippers.
Is there like an oversupply issue? Is there an over-demand issue? Like what would you point to here? Or is it something completely different?
Yeah, absolutely. So let's look at volumes. If you look at dry van volumes, and we're going to talk mostly about the dry van market, really in the context of what we're trying to point towards today as far as this market flip, I think it's really the most important segment to look at. Right. And obviously it's the largest segment when you're looking at for-hire motor carriers. Volume up significantly year over year. If you're looking at last year, which
quite a bit up, actually.
Absolutely. And what's interesting about that is just like you mentioned, the supply, right? So what's supply and demand. This is demand. We're up significantly this year. A lot of that's being fed by the imports, which have been significantly higher than most had expected, honestly. You're seeing a point where if you look at the Logistics Managers Index, which is put out by Zach Rogers and crew over at Colorado State, they're seeing that inventories have been depleted once again. So if you look at that inventory level, it's getting close to where it was even in some of the lowest periods during COVID.
Right.
So the reordering that's going on, taking place from overseas, there's now tariff concerns, things of that nature. We'll touch on that in a little bit. But volumes are up significantly. So from a demand side, looking quite strong this year. But rates, again, going back to that last chart, haven't seen that upwards pressure that we would typically see given that demand, and that's due to that oversupply. And so when we're looking at, how those two relate, they obviously are going to create these rejections. And this is what I meant really by these service failures.
Right.
If you look at 2019, we've really been trending, very close. If you looked at outbound tender rejections for all modes combined, we're almost right there at 2019.
Yeah.
A little higher for dry van. Again, if you look at 2019 in red, last year, which is going to be in that light blue, you're really seeing some nice upward movement above both those years. But obviously, what we're really looking to get to now is 2022,
right.
Which is that green line. You can see how where the freight recession really began.
All the way. Yep.
Exactly. So there was a huge downward pressure on spot rates during that time period. Rejections being the main leading indicator of spot rates, because again, the higher those rates go, the more pressure there is upwards on those rates, the more carriers will be more likely to reject their contracts and go in search of that higher paying freight. So this is really the dynamic between the two. So given that volume, if it were a truly balanced market in the sense that there had enough carriers had left, for there to be less capacity, you would see, more upwards movement in both rejections and rates. But it still just hasn't happened yet, even though my whole thesis here is that it's building and the market wants to turn up. It's been such a prolonged down cycle that we are likely, to see this have more of an impact as time goes on. And we'll get into about carriers leaving the market. I have some charts that I'll bring up in that regard. We really go into like which markets that I'm seeing are most likely to be those leading indicators. And again, that reordering cycle being very important. Also, you're thinking about the Red Sea. You're thinking about these disruptions that have happened for these importers bringing freight from overseas. I think all eyes are really on Southern California, which Los Angeles and Ontario comprise about 7% of the truckload market. So it's a very, very meaningful, and then obviously Long Beach and Port of Los Angeles handle majority of the import freight. That has been a little bit different over the last couple of years, but we're getting back to a period where really those ports are performing like they were, in some of their best years. And so you're seeing, if you look at year over year, they're both doing, incredibly well just on a year over year basis. But if you look at the context of the last few years, we're on that upwards trend. We're still not back to where we were during COVID, but we're certainly trending in that direction. So when you're looking at the ways that this freight travels inland from the West Coast, there's two primary ways. It's going to be by drayage to a local warehouse, and then it's going to move out via truck, or it's going to go on the rails. The rail volume in white here, this is looking at total outbound loaded rail container volume. So this is the aggregate of both domestic and international containers moving on the rail. So when you have an influx of import freight, which we've been saying is on an upward trend, they're doing really well right now, especially on a year-over-year basis. A lot of that freight, just due to that prolonged down cycle, that market share has been captured by the rails again. Well, if we're talking about congestion, we're talking about delays, we're talking about increased shipping costs, tariff concerns. I mean, it's hard to even, remember every single disruption that possibly could occur or is partially occurring at the moment. But what we're seeing right here is a couple of weeks ago, I had pointed this out to our team. We're seeing really peak volumes for rail containers moving from Los Angeles. So that includes those international containers. And it also includes a lot of that freight that may have even traveled on international containers and hit intermodal. Because the rails were trying to capture more of that volume. We'll look right here. So we peak here. And remember what happened in 2021 when the rails just simply turned down volume.
The entire year from 21 to 22 as well. You can see it starting to make its way down. But at least all the way up here during what would be essentially the peak. For it to be about as high as that now, I think is pretty noteworthy.
Well, you're touching on an incredibly good point, right? Kind of that mix here. This is a little bit different than you would see across other charts because that downturn in 2021 was when the rails said that they weren't accepting any more rail containers inland. They got so backlogged. So again, demand for the rails increases to a level that perhaps is unsustainable in what happens to the truckload market, because the more backlog, the more these shippers get real, the sense of urgency around their freight increases dramatically. So now, look, it's already spilling over the truckload market. Now, that's Ontario in red, that's Los Angeles in green, but I think if you look at the green,
it's creeping back up to it.
It's the way that's increasing. Ontario is mostly a warehouse market. If it's coming from Los Angeles, it's typically this transshipment, transload volume. To me, I'm sitting there thinking the rails are having a little bit of trouble, having a little bit of, and maybe it's not even that their service failing. It just, the shippers can't afford the time. They can't afford the time on the rail. They've got to get it in a truck. So this is a really important dynamic, I think, that's playing out right now. And I think that is a really key signal, kind of this breaking point that could be occurring. If you look at ocean container rates, it really kind of shows you why there's beginning to be this sense of urgency and what's happening on the ocean, and why I my thesis is really there's a truckload market flip brewing, but it's currently on the ocean. This is a primary trade lane for importers, Trans-Pacific eastbound. You're looking at China, East Asia to North America, West Coast, North America, East Coast. East Coast is going to be in green. West Coast is going to be in white. See that gap is narrowing. What you're seeing here is that the West Coast being more favored, or being favored more by importers. However, both trend. I mean, look at the correlation between the two.
They trend identical. Just about.
They literally, the spread between the two. Like you mentioned with the Panama Canal, you will see the spread widen. It basically it becomes more attractive to go West Coast versus East Coast, and sometimes it's not even about rates as much as it is just urgency,
time,
time exactly, because it is obviously the closest. So looking right here, we are now at a level that is approaching even some of the highest levels during the pandemic. So what are you seeing from ocean carriers? Ocean carriers are rejecting more freight. They're doing the same thing that we suspect may happen in the truckload sector, which is carriers who have signed, these low rates during this period are now finding it more attractive and taking advantage of the spot freight, the higher paying spot freight. So this is representing the spot market, these two. And if you imagine contracts being drawn, essentially, let's say they were re-signed right here, where you're already out of that. And this is bound to go, nearly parabolic. There's really no end in sight because ocean carriers, there's only 9 of them represent almost 90% of the world trade. There's 3 alliances across those. So you're looking at a huge concentration of power from the carrier side, and their ability to push these rates higher is nowhere close to such a fragmented market like the truckload market.
Right.
There's so many carriers that barriers to entry so low. It's really the opposite in ocean.
Oh, yeah.
So what would you expect to see with rejections right now? I think rejections would almost be at an all-time high. So really no end in sight here. So from a shipper's perspective, you're thinking, oh my goodness, my cost per containers could go up another $5,000 to $10,000. So, and you're heading into peak season. There's tariff concerns. There's an election. So the uncertainty that's building is only helping to exacerbate this because the more demand goes up relative to how carriers are acting in the market, and congestion that's building, these rates are likely to go quite a bit higher, in my opinion.
How do the delays that are being caused by the attacks in the Red Sea affecting stuff like this? Because some of the shipments are now taking 2 weeks longer than they would have.
It's almost like these charts are set up exactly how you're
I swear I didn't see these charts beforehand either.
Yeah, but it makes sense, right? Like what is happening? Well, Singapore, if you think about freight, the Red Sea, the volumes, how they're shifting, maybe a little bit from China to Vietnam. Well, Singapore becomes an enormously important transshipment port.
Interesting. Okay.
A lot of volume that even picks up from Vietnam, some Southeast China.
Those 2022 levels. Jeez.
Exactly. Well, this is what's really important, in my opinion. Is this is data from Project 44. Project 44 tracks these containers in real time. So we're looking at dwell time in white. This is the amount of time a container waits from the time it offloads the ship that it first traveled to the Singapore on to the amount of days that it stayed there until it loaded the next ship. I mean, that's a pretty serious upward trend. But if you look at the container rates, almost, we're again seeing this building. Okay. So this is more the congestion. To me, this is more of what's going to add pressure to the rates. Yeah. But this congestion is really important for Singapore because I think it just helps add a great deal of context to what shippers are facing.
Sure.
So the more those containers are waiting, the more of those containers that are being rolled from one vessel to the next, which is the percentage is in here in red, almost 47%. That red line's almost clearly in line with some of the worst of the pandemic. The white line certainly could get there based on that.
It's looking like it's on its way.
Well, it would certainly be indicative. The red, in my mind, leads the white. So it's one of those things where the higher that goes, the more likely the white is to go.
Yeah.
So why is that all important for the U.S.? As delayed as those shipments become, they're going to come into the U.S. and they're going to be hot. They're going to be urgent. They're going to need to get to their end destination. And we saw this during the pandemic when demand continued to surge, the urgency around these shipments. You really had to get your freight out of Los Angeles, Long Beach. You could not afford the rail. The rails were rejected. I mean, it really was kind of a super tight expedite type of market.
Sure.
And that only helped to exacerbate truckload because where are carriers going to go? Carriers are going to go where they are going to earn the most revenue, therefore the most profit. They're going to go where the opportunity is. So I think that you're going to see, this is why Savannah and Los Angeles and Long Beach, in my mind, are heating up. And we'll talk a little bit more about that as far as Savannah. But this is a really key leading indicator why the truckload flip may be brewing on the ocean right now. So now you're sitting here going, okay, well, Los Angeles is just from the reordering cycle, just from the tariff concerns, just because it's the closest port. Yeah. Now we've got inventories that are low. They need to be replenished before peak season. So now you're looking at, this is counting the numbers of bills of lading, but this is also representative and highly correlated to TEUs. Now, you're seeing some really off the map numbers here, but this is bills of lading. To me, this says, and you see this in the ratio of TEUs, meaning 20-foot equivalent units or containers, to bills of lading. Bills of lading can be surging like this because what shippers are doing is in a period of high volatility where they're maybe likely to get held up by customs due to tariff concerns, they start to put less volume on a bill of lading so it doesn't get called through customs. Very interesting dynamic. And one that I think is important, because if you looked at this just as if it represented containers, you're saying truckload market flip is inevitable, happening, it's going to happen. I would say that, this is really important, but the TEU number aside this, it's trending alongside it. Imagine if you had like a moving average here, but still elevated. And this is Long Beach is handling incredible number of containers right now versus last year. I mean, we're talking potentially 40 to 50% more. And how that all shakes out downstream, again, with the rails being potentially at an unsustainable level, you could see a lot of this freight start to spill over into the truckload market.
What exactly is driving this high volume from the oceans? Because it was obviously fairly dry for the past year or so. And I mean, I can't point to any one particular thing that just pops out of my mind as to why this is happening. Is there any theories you have?
So what you saw during COVID was a just-in-case management system for inventory. I've got to have it here in case something happens. There's just so much uncertainty.
Right.
That now turns into an inventory glut in 2022. The freight spigot turns off. All indices go almost straight down. Freight recession. Then containers stop coming in. So now you're looking at this period where shippers are now saying, this just-in-case inventory management, I've got way too much inventory on hand. Let's run it leaner. Let's go back to this just-in-time. Well, just-in-time gets you back to where you are highly exposed. It's a risky move because of what if consumer demand stays elevated and you're predicting it to go down, then, and this is what's happened. Now, inventory levels, again, you're looking at some of the lowest readings that you've seen really since, not pre-COVID, but when COVID first began. Right. There was a huge surge in demand. Inventories were really low. You're looking at a time period where that's happened again. So this reordering cycle of inventory, now that shippers know consumer demand may stay even more elevated, it's not necessarily they're switching back to just in case. There is a lot of uncertainty going on. And specifically, they're really looking for a big retail holiday season. Yeah. So when you're looking at July 4th holiday, you're looking for what happens after that. I mean, you've got really all these shippers that need this inventory here, really by October, maybe even by September, in a lot of cases, to catch that holiday retail season. So that's really what's happened here. So this one right here, I think is really interesting because, again, going back to that Los Angeles, Long Beach, what I wanted to show you is the average length of haul. So what you really are looking at too is it's not just the volumes coming into Los Angeles, Long Beach, but the nature of what's happening with the reordering cycle and inventories. You tend to see, if the rail wasn't capturing that volume that's going inland, in the nature of how that travels, it travels decently long mileage. It's not really a huge advantage to send something on the rail, super short miles.
Yeah, if you're putting it on a rail from the West Coast, it's going pretty much to the East Coast.
Typically, I mean, Dallas is one of the largest. Chicago's another one of the largest. I mean, just those alone, right, comprise about, it's got to be well over, 45-50% of the volume that travels along that same corridor, whether there's, that same rail line that's going to those two destinations, whether it be Phoenix, whether it be, somewhere in between. This average length of haul. So what would you want to see if you were curious about how much rail volume is now being converted into truckload? That truckload length of haul would certainly go up. So dry van length of haul out of LAX in green. Okay. And you remember that chart that was trending up just based on the volume. So basically it's saying that volume is traveling longer miles. And you can see back here, a lot of freight was getting converted back over to rail, really a bad period at the beginning of this year for freight. I mean, some of the indices that we're looking at, we're hitting some of their bottoms earlier this year, even though we would say that the majority of what we saw, the freight recessions of May 2023, the average length of haul should be going up. That's what you're seeing here. We're going to watch freight to Phoenix, Salt Lake City, Denver, the stuff with that typically has these shorter transit times, because if you look at how the trucks are moving, they're coming back quicker. Then you're going to start to show it up in these longer miles. I expect this to continue to trend up, and certainly from Los Angeles, which we said is not the main warehousing market, it's the main transloading market. Right. So the volume's coming in from the containers. So I expect to see Los Angeles really start to overperform here. And there's been periods where dry van freight, and just looking purely at dry van freight, that Los Angeles volumes have almost approached Ontario levels, and that's
Yeah.
the really interesting dynamic happening.
I was going to say, this is an interesting graph to me because I think it's honestly good news for anybody that's a carrier or a trucker, because now at least you're not getting outvalued by rail. Or if you are, well, I guess it depends on how you measure value. Like you said earlier, there's a sense of urgency. So obviously get it on a truck, don't get it on the rails. So obviously if there's a sense of urgency, spot rates go up. Might keep some of these carriers in the market a little longer than maybe they had expected with the way that it had been going for the past year or so. So to me, that's great news for all the carriers out there.
Well, in July 1st, let's don't downplay how many RFPs are going to be going into effect July 1st.
It's RFP season, yeah.
So if you look at, these are historically low contract rates. The moment this market starts to shift, those, and this is where the risk lies at shippers. It's unfortunate, but it's just true. The shippers who have been pressured to really reduce costs, really been chasing the bottom dollar for contracts, are going to see those contracts opted out of almost immediately. And it's not just going to be, this isn't something that brokers doing. What we're measuring is typically more asset heavy from the contract side. Those asset-based carriers are going to really be in search of that higher paying spot freight.
Yeah.
And so the carrier's going to where the opportunity is. You could say that that's going to create some oversupply, but what happens is it sucks capacity in. So now these other markets start to see more tightness in their truckload markets because of the capacity that's being sucked into where the opportunity is. Yeah. And that's why it can kind of create this.
It's a ripple effect.
Yeah, exactly. And I think it's not just Southern California. It's really important. But what's happening with the Southeast is arguably, which is the second highest volume truckload market. Southeast, and then first is the Midwest. That's actually showing some incredibly good signs. And I think the length of haul from Savannah is a really major indication. Believe this length of haul. You are having, so imports, look at imports, right? You've had Baltimore. Baltimore is really interesting because there was some containerized freight. IKEA, I imagine a lot of these guys have transitioned a lot of volume to their major distribution centers on the East Coast. A lot of those are in the Southeast. A lot of those are in Charleston, Savannah. Most of them are in Savannah. So really looking at adding some volume to the mix for Savannah. So Savannah looks really well positioned to kind of continue this upward trend. Yeah. And if you look at the year over year numbers, obviously, I think those can be misleading because we've been so far down. But look at the length of haul. This tells me that if more congested Savannah gets, and we're already saying Singapore, Singapore's getting a lot of that transshipment freight to the East Coast. Yeah. It's a traffic jam can start to build in a way where multiple vessels are calling multiple ports. Savannah sometimes is on the rotation from New York down. You're just going to see a backlog. The more that backlog builds, the higher this length of haul is going to go, because those shippers now have to really, move that freight as soon as possible to those end destinations. Can't afford the rail. And you're already seeing rail volumes drop off. If I had that up here, you'd imagine where it's going. The rail's losing some market share.
Yeah, they're
going to
be getting closer for sure.
And then in red, what we have pulled up here is just weekly custom shipments.
Okay.
Again, looking at those bills of lading coming in. Again, year over year looking really strong. I expect, this next month, if you were to look at June, for June to be one of the highest months of the year, if not the highest. And then we're going to see kind of that trend continue because peak season really showing that demand is going to be strong out of that market. And so that's, again, sucking capacity. If we look at some of these rates, specifically Atlanta to Harrisburg, Zach Strickland with FreightWaves called this out in a Chart of the Week article. I thought it was really, really brilliant because when FreightWaves was beginning, it was looking at creating a futures market for freight. And what you would want to do is create the most liquid lanes, one of the most high volume. And what I mean by liquid is the most high volume, the most freight moves in that lane. It's the most indicative of the greater market. Atlanta to Harrisburg, Pennsylvania. If you look at the purple line up here, this is contract rates. Look at spot rates in green. What's important really is mostly, because there's never a perfect rate per se. Oh, yeah. But the direction of these is incredibly, this is a really solid, it was one of the best, it's an industry best analysis of the spot market and contract. So you're seeing contract rates kind of turn back down a little bit. But look at rejections.
Yeah, within 2 months, it just...
Okay, so we're already that high. I think in his article he had said we're somewhere between 16-20% up from even May. So look at May's rejections though, and look where they're at now. So to me, this rate, these spot rates haven't caught this peak that we're seeing prior to July 4th. And look at the threshold between the spread between the two, which is really important. The closer that narrows, the more carriers are opting out. And if with that turning down, you're really reaching this inflection point on this lane in particular.
As you can see, obviously, it seems as though the leverage that the shippers had is dwindling a little bit.
Absolutely. Pricing pressure changing this most recent spike. Now what happens after July 4th? Let's just say that, call it for what it is. But it is a kind of almost a 4-day weekend. It falls on a Thursday. Most people, Friday off. And it being one of the most liquid, right? One of the most highest volume. It's going to take a lot of change to really push that and close that and kind of flip this market in particular. But look at what's already happening from Savannah to Nashville. So Savannah to Nashville is, it's obviously very, very close in terms of origin proximity to Atlanta. But the reason I wanted to point this out is because Savannah rejection rates, specifically in the drive-in market, back to that thesis about how import freight's affecting it. Most of what you're seeing out of Savannah is this directly from the port volume. We already saw average length of haul going up. This, my friend, I think is very interesting because spot rates in green, contract in purple. Look at where contract rates are going now.
Well, back up.
Exactly. The inflection point occurs. Spot rates go above contract. Contract starts to renegotiate in that cycle. So we're already seeing it. So when you're looking at national averages, be aware there are signals, key signals, leading indicators that are indicative of a greater market shift if they continue to build. Now, that if they continue to build post July 4th, we're watching it closely. However, the advice to shippers is be very careful right now with what we're seeing in the market. If a hurricane hits, with you chasing the bottom dollar contract rates, and it's nothing. I mean, I understand why they're doing it. It's cost savings. It just is what it is. But you're really leaving yourself exposed to this potential upturn. And what I'm saying is that the signals that are here on the ground in the U.S. today are not what we're going to see 2-3 weeks from now. In my mind, you're going to see some of these create so much friction, so much weight in the market. Carriers are going to flock there, suck capacity. Most people think there's too much capacity. I don't think it's necessarily a bad thing because maybe those people who are hanging on are more. They've really gotten leaner. Maybe it's maybe the capacity that's still here is more sustainable in some form or fashion.
Sure.
But regardless, I still think there's enough pressure building to create a bull run, not to the epic proportions of 2021, 2022, unless something really anomalous.
Unless the world shuts down again,
it's possible.
That whole thing.
It happened. It happened last election season, right? It's one of those things that it's like let's keep but there's really no room left. The pressure, if it was a pot on the stove, it is ready to boil, and it whether it's gonna boil or not. Again, we're saying that the case is building stronger every day that we move on.
Yeah.
After July 4th will be critical. There will be this significant drop off right afterward because it's the holiday. Not many people are working.
Right.
However, what we're saying is they're already in place, the inventory rebuilding, peak season, ocean rates, tariffs, that you already have like the case to be made for after July 4th, like already being made.
Yeah.
So the chances that this continues when we get like mid-July to the end of July into August,
sure,
is certainly, that is a case to be made, and it's a very strong case at this point.
Well, what would you suggest then that, shippers who have had this leverage for the last year or so, what can they do to start to maybe protect themselves or put themselves in a better situation, if the market does flip and it's not quite as much in their favor anymore?
You have to be realistic. You have to be, if you're running lanes at below cost right now, which I've seen, that's unsustainable. You may have gotten away with it for a period of time. You're now reaching a period where carriers are going to be increasingly more likely to go where the opportunity is the moment something happens, because this is happening in mass. Shorten your bid cycles. The best bids I've seen, just make it easy for people to provide rates. Try to get your all-inclusive rates. Try to make sure the fuel makes very clear sense as far as the fuel surcharge. And just shortening those bid cycles can give you, because you can imagine, if you're going and bidding for a year or 2 years, you're really, as a carrier, that's a very risky move. And then the payment terms being 120 days. I mean, a lot of shippers are moving to that. That can bankrupt someone pretty easily if the market shifts meaningfully. So getting a way to track the market transparently, getting a way to understand and having the dialogues with your brokers, your carriers about what's happening in the market. And again, an objective source of truth really helps. But then those bid cycles, if you just do 6 months, if you just do a quarter, that gives you an opportunity to say, where am I at today? Where am I at in 3 months? We're way more likely to be able to tell you where we're going to be in 3 months than tell you where we're going to be in a year.
Yeah.
And then, 3 months is typically the shortest you're going to see, but I think 6 months tends to be one I see more frequently. But you're already seeing shippers renegotiating rates that have been in place for a year to 2 years because they kind of feel this pressure already. And margins are getting compressed, especially for brokerages, carriers. It's one of those things where the more those rates come down on the contract side, and then you're kind of, again, we're talking about basically they're meeting, spot rates are on the incline.
Right.
That's a point where you really need to be, honest as a company and say, I really need to look at giving the people who have treated me well over this downturn, were there with me during the pandemic, give them a more sustainable rate long term. And I think maybe having a way to track these and being able to renegotiate based on pure data is really becoming the more more favorable way to do it. And I think one of the best ways to do it. With KCH, we'll continue to keep you updated. And I think it's something that we strive to do as a company is inform our clients, give them these objective data points that can help support, why something's going on, help them be ahead of the 8 ball. And I think the people who are paying attention, it's not necessarily that I'm going to be right. It's just that I've seen a lot of this over, my tenure. And it's one of those things where these key leading indicators could very possibly end up being the thing that really, the straw that breaks the camel's back. And I think it's one of those things where as a company, we'll strive to make sure, our clients are and the people out there in the market are as informed as possible because that's really our duty as a broker.
Of course, man. I think it's our job, obviously, to know what's going on in the market and to make sure that we're providing, not only shippers, but also carriers and just people who are in the industry as a whole with the correct information to really make sure that they are making an informed decision and putting themselves in the best position to succeed as we try to do for them as well, is to make sure that they're in the best position to succeed with all the information they would possibly need. And, speaking of information, if you wanted to find any more of these market updates or anything more about us, all of the social media stuff, website, all that good stuff will be down in the description below. So feel free to check that out.
Absolutely. It's it's looking like there's some excitement building, and it's certainly when you're looking at the data on a daily basis, it kind of helps create a little bit of momentum, and it's exciting, kind of an exciting time brewing here.
Of course, man. And we'll be sure, obviously, to keep you guys updated weekly on what's going on with the market, and we'll have some follow-ups on everything that's going on here. We'll see if Henry's right. I think he's right. He's a pretty smart guy. Thank you guys for joining us, and we'll see you next week.